Alright, welcome back. This is video 5 of phase 1, Intro to Institutional Candles. So what we're going to be going over is some examples how to find an institutional candle, how to identify it, because not every up candle or every down candle is an institutional candle, and I'm going to be showing you specific examples and setups to look for to give you the confirmation that that's the candle that you should be looking at. Because too many people, I've seen this where too many people get confused when they're learning this stuff, or they have, a bad mentor, or that person learned it from somebody else or learned it from somebody else, and now the information has just been diluted and confused. So what an institutional candle actually is it's a candle that when it's printed, you can see that it was purposely printed in order to sweep liquidity. And liquidity, as we mentioned before, is buy stops, sell stops, and stop losses. So above old highs, you will have buy stops for retail traders that want to go long. Below old lows, you will have sell stops for retail traders that want to go short. Also around those areas, if you're looking at the patterns that we looked at, there's double top, double bottom, there's trend lines as well. All of these will have stop losses near them. So again, for the market to be efficient, it will hunt for liquidity or money, so it will drive price in that direction of those stop losses to have liquidity fed into the market. So a candle, an institutional candle, is essentially the candle that sweeps liquidity. Okay, so we're going to be going over some specific examples of exactly where it's printed and how to know that's the right candle. Because some people, again, I mentioned, they get confused and they think, one candle is the institutional candle, but they don't realize they have to cut through candles and go look at a candle that was 3 or 4 candles before that one, which was the actual institutional candle. Because it's not always the very last candle, which people get confused, because people explain order blocks or institutional candles as the last up candle before the down move, or the last down candle before the up move. And a lot of the times that is the case. However, also in lots of times it's actually the candle before that, and they don't realize that, because they're selecting the last down candle. However, that candle wasn't printed the way an institutional candle is. Okay, so I'll show you exactly what I mean here. So we are on GBP USD on the 15-minute chart. You'll see price is trading lower, and then it stops just above this low. So there's resting sell stop orders below this low. And now when people see price reacting in this area, they're also going to assume that's a double bottom and they want to see price trade higher. So right down here, so that's your liquidity. That's retail stops. We have a drive lower and then a very strong movement away from it. So when price does this, when it drives through an area of liquidity and then quickly rejects and gives you a reaction in the opposite direction, that is a very good indicator that that's an institutional candle. So you've got your liquidity swept, your lows. It will also leave imbalance behind. So, we're going to be going over imbalance later on, but essentially a balance is a gap in the marketplace where price hasn't been delivered, and that happens when it moves too fast that it can't efficiently deliver buying and selling. So it leaves a little gap, so price always trades back in to add the opposite side of the market to that area, as a quick summary. So right here, price drives lower and we sweep this liquidity and then gives us a big push to the upside. So when we get back in to this down candle here, that institutional candle where they sold to drive it lower here to then buy up, when it trades back in, they're taking those sells off right here. This would be inside the London session, 3:45, 45 minutes after the London session starts. And then price comes up and creates lots of equal highs. So right here, we've also got a high over here and a high over here as well. So that would be your buy stops. The price comes up, stops just right in this area. So people are expecting a turnaround because they think it's a resistance. So they will put their buy or their stop losses up there as well as buy stops. Typically on equal highs, it's going to be stop losses because people are selling on those equal highs. Now this down candle, for the up move, we identified it, it made such a quick move that it did leave a little bit of an imbalance behind right inside of here. Right there. Liquidity was swept on the bottom side. So now if we're looking at where is the money, all the money is sitting on the top side here. So that's where the price is likely to be driven to. A little bit of imbalance there. Let's just mark that up. Good. So we also had a breakup structure in here as well. So when price comes down, sweeps these lows and breaks structure to the upside. So it closes above this high right here. That's your break. This is your range from this low to this high. And you're looking for an entry when it pulls back. So we've got our imbalance, we've got our institutional candle, we've got money sitting up top, we've got our low swept on the bottom. So this is all a good a good setup with these confirmations to take a buy when we get back in here. And if you miss this one, you can see we trade lower, run this old low, which will have stop losses in there. For people that are long and they trail their stops, they will move them up below this low. So we run that low here and trade back into this again. And this gives you an opportunity to be long, to get above this high. You can see right here, we have another drive lower, and then a massive move up, clearing out the buy side liquidity. And then see a big move down, just boom, right down. And here's 9:15, so this was the New York Open where this happened. But now, if we do this for a second, okay, and you can't see what's coming next. If you were to look at this chart and you see, we had a low here, the low was taken out. We got a nice opportunity for a buy to then take price above this high. Where are the stops? Where's the money now? The money is sitting below these lows on the sell side because people are trading and they're putting stops below here, they're buying, and then price comes up here. People are looking to buy, looking at this as a bull flag, which is a retail pattern. But again, in order for the market to be efficient, it has to have money dumped into it consistently. So the liquidity or the money sits below all these old lows now. So this is likely where the price is going to be driven. Okay, let's just put this on the chart here just to make it easier to see. Below there. Sell stops all below these lows. Put that there as well. So if all the money's sitting down here and the market's going to want to go down below here to have money, you know, fed into the market. So as we can see, let me put this here as well just so you can see it, like the equal highs. They're taken out. So here's another setup for an institutional candle. which one of these candles is the institutional candle? Right, we can see the money was swept up here, but you know, would it be this one, or this one, or this one? A lot of the time, people are looking at this candle, but which was the candle that made a massive aggressive move upwards that actually took the highs out? It was this big candle right here. Okay, so I'm going to put a line right there on the body of the candle at 1.3859. So now that we've cleared the bottom side and we cleared the top side, retail is looking at this as a bull flag, as a buying opportunity. On these smaller time frames, we would have a 5-minute close above this high, so then people would be looking at, okay, we just broke structure, we just made a higher high, so then we should make a lower low and trade higher, or higher low, excuse me, and then trade higher. So it's very, very likely there's going to be all these stops sitting on the bottom side. We get below the bottom side, price trades back up. They're still holding the buys that they used to drive the market above this high. Right, that's your institutional candle. You can see it left some imbalance because of how aggressive the move was. It was filled on the way back down. Okay, but just the way this candle was printed, the fact that right before these highs, it had a very strong reaction, gives you an indication that that's a bank-sponsored move. So when price comes back into here, you can see this took out this high, and barely, but just this high as well. Right, so it ran a lot of stops. Now overall, the direction is bearish. And you can see they keep reaching for the top side. But you see the overall direction has been bearish, so you're looking for selling opportunities. Moving back here to where we were. So this candle here, that's your institutional candle. This is where you can look for a sell right off the body of this candle, because this is the one that swept the liquidity that took out the highs. So when price comes back into it, right here, this is where you can be a willing seller. And as you can see, price makes move lower and you would have been, you know, done for the day. Okay. Go to the next setup. Moving along here. All right, you can see right here we had an aggressive move down below this low. Now I'm also going to put a line on the screen. All right, think, why did it react in that specific area? Okay, so let's put a line right there. Oh. All right, then we're going to go all the way to the left. All right, so you can see this old low. There's sell stops below this low. And there's also people that are long that are trailing their stop loss, and they trail it below this low as well. So there's liquidity below this low, and price just barely dips below it, as you can see. So we'll go back to the right over here. Oh. All right. So they sold, the bank sold to drive price lower and sweep liquidity, expands to the upside. So this is where they're holding sells. You can see we had a push down, then a quick aggressive move away from it. When price trades back into it, you can be a willing buyer. Right there. That's inside of your London session. And you can see again, it gives many opportunities for a re-entry as well, trading back into this candle here, your bullish order block, expanding. Remember, the overall direction is bearish, right? So yes, you're trading in a counter trend here, so just keep that in mind, but you can still definitely take trades. Let's have a look right here. You see we have some highs over here. Price comes down and creates some equal lows, so they develop liquidity on the bottom side. They run the stops up here, the buy stops, and then the price trades down, trades back up into the body of this candle here, and then makes an aggressive move lower, clearing out the stops on the bottom side. Okay, next example. Right here we have a move lower and then a move higher. Drop down. Now I have a high here, some highs in here. Now there's people that are going to be trading trend lines as well as another type of liquidity, specifically right there. So they want to sell every time it comes and taps an area of resistance or liquidity, or yeah, an area of resistance, which they would consider the trend line. So price trades up through these highs, clearing out the stops on the top side, makes an aggressive move lower. So as we can see, a push up and then a big push down. And price trades back up into the body of this candle. You can be a seller because this confirmation of the stops being run, the way the candle is printed, the structure breaking to the downside and is in a bearish move. These are all confirmations you can use to then have confidence in your trading and take a sell right here. Okay, next example. Going to go all the way to September for this one. Let's clear off the chart here. All right. Here we got some equal highs up here. So we have stop losses sitting right above the side. And then we've got an old high over here that we had a push up and then a big aggressive move down, and it left a big imbalance in the market right in this area here. Right here. And we'll get into imbalance in depth further on. But right here, this is your institutional candle because it swept liquidity and it had a quick run away from it. You can also see down here we have some relatively equal lows. So that would be your people, your retail traders buying support, anticipating support. So they're putting their stop losses down there. We've also got some old lows over here as well. As you can see, we got all the way down below this low here. But have a look at what happens. Price stops and starts going bullish on purpose because people are anticipating its support. And then boom, drives lower through it. We trade back into this candle that got below the low. That's your bullish order block. That swept the liquidity that was over here. It starts expanding to the top side, looking for equal highs. And we are going to look right here to be sellers. So if we move price to the right, price comes in. The bank closes those sells. that they put in the market to, or closes the buys that they put in the market to run the high out of the market. Price trades down lower. So at this point, you will be break even on this sell. So depending on your risk management, what your parameters are, you could have caught a nice entry right there. Your stop loss above here. You can also, tighten the stop loss to here if you would like, but you have to break it down onto the 5 minute in order to do that. Okay, but there's a healthy trade right there. And this pattern is consistent, continuous. It happens so often, and it's just training your eyes to see it. Because if you've seen this happen 1,000 times, and you go into the market and you take a trade, and you've seen it, you've back tested it, you've gone into replay mode, and you've just conditioned yourself to see these patterns over and over and over and over and over again. It becomes second nature to the point where you can go in, see this, pull the trigger, and have it hit consistently almost every single time. Now, are you going to lose some trades? Yes, you're going to lose some trades because not every single setup is perfect. Sometimes the price will come up into your area and go through it. It happens. You're just on the wrong side of the market, and that's okay. We all make mistakes. Yeah, but it's understanding, where is the money? Where are the stops? Was there imbalance left behind? Where do they want to take the price in order to have money dumped into the market to keep it efficient? And if you realize that, okay, the stops are on the top side or on the bottom side. So let's say the stops are on the top side, and then you see money taken out on the bottom side. You can be a buyer right in this area inside of this down candle, because let's say there's some equal lows over here. Swift liquidity comes in because on the top side all your money sits up here, so you want to be a buyer even though everyone else is trying to sell because they see this as a market structure break getting below these lows. But they don't realize that the liquidity to me is, I would say, more valuable, or not more valuable, of higher priority to pay attention to the market structure. Because on the 1 minute, I trade the 1 minute a lot inside the New York London overlap. That's that's my session. That's what I trade. I don't trade London. I just trade New York. You can just trade London or just trade New York. You can do both. Personally, I found for myself, New York is what I trade. That's just with my schedule, and that's what I like to trade. So, that's for me. But this week has been, Euro has been very bullish. The week right now is September 3rd. So over the last, couple weeks, it's been bullish. And there's a lot of people, it was coming up to some old highs, and there's a lot of people looking to sell it. But price started walking down, right? It started doing this. And then broke structure to the upside, traded back in to the last down candle, which is your bullish order block, and then took a buy. Because I knew that the stops are on the top side. Right? All the money was sitting up here. But people just throw, the liquidity out the window for structure. But if anything, you should pay much more attention to where the money is sitting in the market versus the structure. Now, am I saying structure is unimportant? No, I'm saying it's extremely important to know structure. But you can't get lost in just looking at structure, just looking at one confirmation. Because, again, I had this conversation like last week, and I was talking to somebody, and, a pair had some highs, right? I had some highs over here, and price trades through the highs and then quickly comes straight down. So to me, that's a stop run, right? That's liquidity swept. So I'm looking at selling from this area, because on the higher time frame, there's a lot of old lows down here, all that had stops. So my direction was bearish simply because They cleared the money on the top side, so now it was going to reach to the bottom side. So I wanted it to be bearish for the next quarter. And price was trading down into a point of interest. Right, so there is a down candle. If I draw this out better, so you have a down candle here. Right. And then you have some equal highs over here, or relatively equal highs. They got above them and then boom, break down. And then he was looking to buy out of this. But I was wondering, why would you buy that? Right, because we had all the money swept on the top side. Liquidity was swept, so now all the money sits below this low, the lows over here, so it's likely it's going to continue lower because that's where the money sits. Because they cleared it all on the top side. It was all gone, right? A lot of it was completely wiped out. So now where's the money? It's sitting on the bottom side because there's equal lows, there's old lows, there's so much sitting down there. But he was addicted to structure, and he knows liquidity. He understands the concept. But he said, oh, we got to close, right? Just, this high where it was swept. We got to close above this high. So now this is my low and this is my high. I want to buy it right here. I want to see price do this. But even, not taking structure and liquidity into account, when price got above this, like these highs right here, came up, and then it just started making a big aggressive move to the downside. It was doing that for a week and a half. However, it was filling a lot of the imbalance on the way down. Now, even if we're not looking at the stop sitting down here, okay, and we're not looking at the liquidity and we're still looking at structure, I still wouldn't have even taken that, just because if it's making an aggressive move down like that, and it got about 80% into this down candle here anyways, which was on the daily, I was very, very unlikely to take that, because that, about 80% of the time, probably 90% of the time, if it gets that deep into a daily candle, you're usually wrong. You're usually on the wrong side of the market. And if this made an aggressive move like this towards this low, I would need to see a strong confirmation, like days and days and days of it going up, and then enter on a pullback here to take out this high. Okay, but without looking at this low. But just the way price was delivered, I could tell it's going through that low. So don't get addicted to just looking at structure, because this week that I mentioned, I've been trading reaccumulations every single day, and they've been hitting every single day. And I've been catching buys every single day for like 2 weeks on EU, because it'll do this. Watch right here, it'll do this. We'll have some lows over here. What does it do? Breaks down, and then people are looking for sells, but the whole thing's a reaccumulation because they're just addicted to staring at structure, right, without realizing it's walking down like this, but there's stops up here, in over here in this area, there's highs, there's equal highs, there's a lot more money on the top side. So structure aside, people are looking at this for sells. I still want to see price move to the top side to get that money. So that's why inside of here, there will be a beautiful 1 minute break of structure, and you can enter on a pullback to then take price higher. If we go to the left here, just to show you all of these highs. All of these highs, that's where a lot of liquidity sits. So price is more inclined to, get driven there to soak up all that liquidity, to have it injected into the market by people's trades being stopped out or being activated. So that's why don't get addicted to looking at just structure. Obviously, it's very, very important to backtest it and know what it is, but pay a lot of attention to liquidity. Okay, for example, right here, we drove below this low, and everybody's looking at selling. So they're selling on this up candle right here, thinking that that's the sell, and price is going to go down because we closed below this low. But they don't realize once we got below this low, we swept all the liquidity. It's all gone. There's no money down there anymore. So where's the money? It's all up here. So where's the market more inclined to go? Up here, above these highs. So then you're looking for buying opportunities. So what happens? Price trades back into this. On the 5-minute, there will be a candle in here. The candle that swept liquidity right here, there's a beautiful buying opportunity. We also have, by the way, that's the New York-London overlap there. Perfect time to trade. We have a re-entry right into this candle right here. Let me just use a box to make it look better. There we go. Right here. Right, and then people are, they're shorting and they're selling it, but what happens? Price drives up, drives higher, and then the stops have been cleared up here. So where's the money? People buying and putting their stops below here. So where's the market going to go? Through the lows. Right? This is something you have to condition yourself to see and train your eyes to look at, because it is so consistent that this would be a much stronger confirmation for me than structure. Now, does it mean I completely throw structure out the window? No, but I'm looking at where is the market going. I identify, okay, the liquidity is on the top side. There's a lot of liquidity up there. My bias is bullish because I want to see price get up there to sweep liquidity, to get above those highs, to run equal highs, to get there so the market can, have liquidity dumped into it. So with that bias in mind, I'm looking at, okay, where can I be a willing buyer to get price to that area of liquidity, and then close my trade and, make some profit. And if you see a low that gets swept and they sweep on money on the bottom side, when they sweep the low, they're just driving price below an old low to collect liquidity and also take trades down there, right? So when the bank gets below this low right here that they did over here, remember how I mentioned that if you're buying and you get stopped out, you're selling your position back to the central bank. And if you're selling and you get stopped out, you're buying your position back from the central bank. So if price gets below this low here, you're selling your position back to the central bank. And what's the bank doing? They're taking the other side of your trade, right? So if you're looking at a sell below this low, okay, just not about stop losses for a second. If you take a stop loss, yeah, you've lost a trade as well. There's a lot of people that are willing to sell below the old lows. Like if you study this, there's so many people. So when price gets down here, people want to be sellers, and the bank takes the opposite side of your trades because there needs to be somebody on the other side of the market, so they're buying. So you can have that sell, right? And then they drive price higher. Look, right here, people buy above an old high. What happens? When they buy, the bank sells them that price, and then they're there and buys, and boom, goes straight down. But people look at this as a high, low, high, low, high, and then they're looking to buy somewhere in this area, and it goes right through it because their structure is telling them that this is bullish, when in reality, this was a sweep of liquidity, and now the money sits below this low, below this low, below these lows in here. So now the market is much more inclined to drive down to the bottom side. So you can't get stuck on structure. This is something that you need to know, you need to understand. And this comes from looking at a lot of retail concepts, looking at how do they trace buy stops, how are they buying trend lines, how are they selling bear flags, all of this stuff. Because once you realize what they're doing, you're going to know the exact opposite of what you should do. Okay, so that was some examples of introduction to institutional candles and going over liquidity as well. And I will see you in lesson 6.